Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. It is Friday, July 14th, 2023. S&P 500 sitting at 4513. I'm David Zarling. I'm here with a father extraordinaire, Ian McMillan. Plenty to cover. S&P, as I mentioned, 4513, right about the level that we saw back in March of 2022. Where would you like to start?
March of 2022?
Yeah, correct.
And
so it's been a while.
And also that neckline from Q4 2021.
Yep, exactly.
Another pretty decent week for stock. I mean, today isn't the best ending to the week.
Just from a participation standpoint.
From a breadth standpoint.
But your big cap names are still doing well today. They're going to finish, that lets the big cap indices like the S&P 500 and the NASDAQ 100 looks like they're going to close the week near the highs of the week.
Yeah, I mean, NASDAQ, Russell, basically right now they're both up a little less than 4%. Well outpaced the S&P this week of about 2.5%. So a strong continuation over what's been a good last month or so.
Yeah, for sure. 6 to 8 weeks. We've seen stocks continue to have demand outpace supply and above that 41.80. I mean, Ian, would you have guessed that stocks would have moved the way they have above 41.80? We knew from an evidence standpoint that above 41.80, that's where sellers had shown up so many times before that if we broke that level, did you envision it looking like this?
And I don't know if I envision it looking like anything other than, hey, above 41.80, better get pretty serious about owning stocks. I should probably be overweight stocks.
And that's really the way to think about it is there's no way to know how it plays out. All you know is that's where sellers, I'll go back to the farmer's market analogy again. You show up at a farmer's market, it's busy, but there's plenty of farmers selling whatever it is, watermelon, corn, tomatoes, you name it. And then you show up one day and there's only 3 and there's a ton of people there. Things are about to get expensive. And that's basically what happened once we broke above 41.80 is the sellers were no longer there and all you had left was demand. And here we sit a few weeks later and pretty fast higher. And now, admittedly, I'm not here to tell the market that it wasn't just short covering.
Sure.
I really don't.
Some people probably a little underexposed to stocks because I mean the headlines have still been pretty bad, or I would say maybe the headlines I see. Not that I go looking for them, but it's kind of hard not to see what people are griping about or worried about. Or I mean it's been a quick 8-9% move. That's the S&P, so I'm assuming that the Russell's been even better.
Well, if we go back to late September, early October of 2022, there were over 33 million puts traded, which was the highest recorded level going back 30 years. That's a lot.
More money in the system too.
Right, correct. And that's a fair point, right? Like we don't have it as a ratio. We just have it as a nominal value.
But it was high. I mean, there was a lot of bearishness. In fact, I was talking to someone the other day. He was saying, they don't short stocks, but how bearish he was on that break. I think it was late September, early October, below the June lows, summer 2022. We bottomed, we bounced from that, and then the big bullish engulfing candle on what was that, the 13th? Yeah, Thursday the 13th. And
we talked about that in the podcast too, that if something was to look like a bottom, that could possibly be it.
Yeah.
And I'm not sitting here trying to give the impression that somehow we executed that flawlessly for our clients, but I am here to say that by using charts, you can identify where, okay, that makes sense that was a significant bottom.
Mhm.
And even internally, we have 12 clients who are worried, and that was happening right at the October lows. Anything from asking to be put in cash to, and that's no fault of theirs. It's just, well, think about that time. We don't get to reinvent the past. Similar to how the COVID story is probably going to unfold. We don't get to just make up how it happened. Same thing with the market. There was real pain in October of 2022. I'm not here to say that it wasn't. It's just interesting that the sentiment at the time, you have record put buying, which is betting that stocks go lower. And internally, we have got clients very much wanting to go 100% to cash. And then you follow that up with January of 2023 with the Whaley breadth thrust, the breakaway momentum breadth thrust, the 770 breadth thrust, which looked in duress in February and March with the mini banking crisis, which I'm guessing most listeners have forgotten about at this time, similar to the submarine.
That storyline certainly died, didn't it?
Yeah, we're forgetful human beings, right? Anybody remember the Russian coup? Anybody remember the submarine? Probably not, until that you heard me just say it just now. And similarly, people have forgotten that, there was a pretty significant pullback breadth-wise in
it's a brittle
February, March. Yeah,
caps, really across most financials.
It was the largest 10 trading day move since 2011. So a once a decade event that took place in banks, and that impacted small caps for sure. But I don't want to say impressive, but just it's great to see that the market moved higher after 770 thrust, breakaway momentum thrust, Whaley thrust, that here we are higher after that and could just be getting started.
Yeah. I mean, certainly not took a break there for a while.
And the break you're talking about, are you talking about the range that took place?
Yeah, just that 4, right? Because those October highs were 41, or February highs 2023 were 41.80, I think.
You had this range that goes back to April 22 in the S&P, and really it's a range in size about 18 to 19% that we haven't seen since the 70s. As market historians, when we look back at previous markets and we look at ranges, they can happen anywhere. Ranges can happen as a top, so distribution. Ranges can happen in a consolidation, so in between trending, so whether it's an uptrend or downtrend, or ranges can happen near a bottom. And in the 70s, it was a bottom, and it was about a 19% range that lasted 170 days. S&P, this going back to April and May of last year, 18 to 19% range that lasted over a year. It's significant from a trend following perspective because sideways means trendlessness, and that's hard for trend following. But here we are continuing to confirm an uptrend on our hands, but that doesn't mean every single day has to be up.
It's true. There probably won't be. Never really is.
Nope. It's a sequence of higher highs and higher lows.
A VIX that near its lows of the year.
And the VIX being, can you walk through for our listeners the VIX and maybe some general rules about it?
Yeah, just
and how to do that
measurement on the S&P, I think based on options positioning, right?
Yeah, it's a way to measure premiums on options. It's the anticipated volatility of the S&P 500. So when we say VIX, it's specific to the S&P 500. We're looking at the 30-day forward, let's call it projection of volatility. And you can take the VIX and you can divide it by, I believe it's the rule of 16. You can divide it by 16. It kind of gives you like a daily, what each day price movement could be up or down. And so we've got a VIX at around 13. That's not a level we've seen. And interestingly enough, from a weekly perspective, we have a bearish engulfing candle on the VIX.
Yeah.
But it's the lowest level basically since June, but also looking back further since 2020 before the COVID.
January 2020. So you know what that means.
Right. We got to be back. And at the same time, there was a period in 2017 where you broke below 13, and that was a measurement of just that melt
yeah,
up.
And maybe that's what we see again, right? So you would expect to see a lot of, I mean, not to be Captain Obvious, but lower volatility days. So not a lot of big 2-3% days like you would see coming out of a bottom, right? Because you're at a bottom is where you get a lot of the mix of highest, biggest daily losers and biggest daily gains. A lot of that data I feel like comes close to bottoms.
Yep.
So you get further and further away from that, and you get into these uptrends where, for lack of better words, people just this kind of as a trickle in effect of people just accepting that the market's going to go higher. I think that I said this earlier, I think that there are more than a few advisors and asset managers, portfolio managers out there that are most likely underweight stocks and have had to. I don't know if we're back to buy the BTFD mentality.
Right, by the dip.
Yeah,
for sure. Well, and let me
and
let me get your opinion on that, because the other side of that thesis is when you look at the NYA Dow Jones Industrial Average, we haven't cleared important levels, right? So you look at the NYSE.
And thankfully, it looks like United Health is going to save itself because it's having a nice day today, and
real critical level
on the verge of. This could actually be very bad. I mean, we did break to year-to-date closing lows yesterday. That will now essentially be a failed break. And I guess, this bigger neckline at 450.
Yeah, no, I think that's a fair thing to say, that United Healthcare was on the ropes. And the reason why you bring up United Healthcare, I assume, is just the Dow Jones is a price-weighted index.
Yeah.
And United Healthcare is the largest priced instrument within the Dow Jones.
Doesn't that sound so stupid, saying that out loud?
Oh, the price-weighted part?
Price-weighted index.
It sounds stupid.
Like early 1900s, before there was any idea that, like, hey, these stocks could actually split in the future. I get that, but...
Well, and think about the ease of it, right? So Charles Dow, he doesn't have a spreadsheet. He just has a newspaper, and he's able to take the industrial stocks, take the top 30, take their price, and make it a price weighted. I get it. And then the correlation with S&P 500 is pretty doggone strong.
What's crazy is you've got this pretty. Hey, thank you, Charles. It's a great invention. It's a great first shot at creating what would be a stock market index. Kind of a way to keep tabs on what the stock market's doing as a whole. And then, when you talk about something so bizarre, be a price-weighted index, and then you compare it with something like the S&P 500, which, for all intents and purposes, we can call it the largest 500 stocks. It doesn't really work that way in the same sense that the Russell 1000 is truly the largest 1,000 stocks. Yeah, totally opposite ways. I mean, totally different weightings, totally different construction ideologies, and yet over time, not always on a month-to-month or year-to-year, but over time, the intermediate to long term, as you said, they're pretty aligned with each other.
Yeah, highly correlated. I'm not here to say that the Dow Jones is bad. I'm not here to say that it's good. I'm here to say that it's useful. And when you look at the Dow Jones Industrial, and remember what the concept that he was looking for is, if industrial stocks are doing well, or if transportation stocks are doing well, the transportation of goods and the manufacture of goods, well, the things must be good. And that premise, I think, is still valuable. And you have the Dow Jones Industrial Average on a weekly basis about to record its highest weekly close since the first quarter or beginning of the second quarter 2022.
Yeah.
Really important level near 34,500 or 36,000.
It doesn't have to outperform. I don't expect it to outperform. It has underperformed for my entire career. And one day I will be saying the opposite.
Well, to your point, what you're highlighting is
it's nice to see it break above this 34, we'll call it 34,300.
And that goes for you look at the NYA or the New York Stock Exchange. It's also, that's a bigger composite, right?
That's a lot. It's like, I don't know. I guess, every stock that's listed on the New York Stock Exchange.
And then, so that's potentially a new weekly closing high above its late first quarter, early second quarter 22 highs.
Yeah.
Not exactly bearish, but let's not mince words. I mean, it's been tech and anything from semiconductors and big cap tech. Like you look at something like FANGs, remember that acronym?
Yeah.
Your Facebook, Apple, Netflix, Google type names on the verge. We've got some time before market close of making new all-time highs. When's the last time that new all-time highs have been bearish?
Not recently, not in my recollection.
Yeah. And so you've got, I think you call them Ian, clear skies, blue skies.
Yeah.
When you have those type of names making new highs and leading the market higher, and not necessarily like seeing small caps move lower, but participating.
Yeah.
It's a good combo.
Micro caps or small caps, got back to above this 1900 range on the Russell 2000. Got there in mid-June and late June. Got rejected, but yeah, held this. Also held 1800 and it's 200-day moving average again. That was a nice bounce late last week and pretty solid follow through. And really another one of those, not as bad this week, but I feel like we see this out of Russell more than the other indices.
Okay.
Is that if you're not there for the Monday move, like the Monday, I feel like the Russell more than the other indices can definitely make like and sometimes a Monday, Tuesday move, but I would say, and then it's kind of flat. See, I mean, yeah, you can have the Russell up 4% on the week, but that all happened on Monday and Tuesday.
Oh, I see what you're saying. So you're saying,
I feel like Russell typically also has like, so it'll be like 4% move in 2 days, and then the Monday morning gap's like 1%. And so if you miss that, now it just strikes me as one of those indices that typically you had to be there on Friday.
no, I like that. I like that from a
Friday to be able to catch a majority of what that instrument's going to do the next week.
Your point is that the market is not sympathetic. It doesn't really care how you want to get in or whether you like what it's doing or not. A characteristic of the current leg that we've seen is that in small caps, the majority of the move is happening on Mondays and Tuesdays. Am I summarizing that well?
Like we see that, you can take July 10th this week as an example.
That's almost 50% of the move.
Yeah. And
then Tuesday, if you just take Tuesday, by Tuesday, you're up 2.8 of a week that's up 3.8.
And then again, so if you bought the breakout, you're like, okay, we broke out. Instead of buying support last week at 1800, but now we're off the lows for today. But
you're only up 1% on a week that's up almost 4.
Yeah, or even, but we filled that gap. We filled what was that Wednesday's gap today, which is fine. I mean, some of these are going to have to get filled in. Doesn't look like we're going to fill the one at 17 or 1750, which is fine, or whatever this is down here, 1760 back from June 2nd. But yeah, a lot of that beta, a lot of that outperformance, just for me, it's just an anecdotal thing, personal experience. I feel like it tends to happen more with the Russell.
Oh, I think it's important to understand when information changes, where if the market's not letting you in, and what I mean by that is what you just described, that if you're not in on Friday and the market moves against you, not against you, or it moves fast on Monday, Tuesday, doesn't let you in, that's information. Like, you do have to pay attention to that.
Well, and then you get into the whole, okay, so Monday, Tuesday, NASDAQ was up 0.5% this week.
Yep.
And then you're staring there at the Russell up 3.5%. Now we get to the end of the week. How about this? We're now sitting here on Friday. I was just looking at this a few minutes ago.
We got some dueling tails.
The Qs are ahead of Russell for the week.
And I know we're kind of doing this in the moment, but if you take that Qs versus small caps chart on a weekly basis, we've got dueling tails.
Keeps consolidating, obviously.
Now, I would also argue, to your point, that the NASDAQ 100 versus the Russell 2000, going back all the way to the 2000 highs in that relationship, we broke above that, and significantly, in April and May of this year. And this consolidation's been really nice.
I know. And, we've got this divergence, RSI divergence, and I get all that.
And are you looking at the RSI?
Until that plays out in price.
When you say RSI divergence, are you looking absolute, relative, weekly,
NASDAQ
daily?
NASDAQ versus IWM.
Okay. And then are you looking at it daily or?
Daily, yeah.
Daily, okay. Yeah, there's a little bit here. But
if this is this tech run's just going to keep going, this is what you would see. You would just see them ignore the divergence.
Wouldn't it be evidence if you see Apple consolidating and moving higher, Microsoft consolidating and moving higher? We just got done saying that we've got FANGs, FNGS making new all-time highs.
And the other thing is, okay, so let's go back to RSI on this relationship, QQQ versus IWM. So in mid-March, the RSI on this relationship, 14 period daily RSI hits 86.
Mm-hmm.
Okay, so when we talk about divergences, I think it's really important where, okay, so that's pretty strong. That's pretty overbought. It's also, from a mathematical standpoint, almost impossible to not have a divergence following a peak high of 86.
Oh, for sure. Yeah, you're just
how
saying
much stronger that chart would have to be to register an 87.
Right. Extremely. And when is it happening?
Yeah.
So an example of this would be March of 2020 in that relationship. That extreme RSI reading is happening during a massive correction. This extreme market reading is happening where the Qs are not that far off from all-time highs. So you're talking about one RSI reading that's happening at the end of a move and another RSI reading that could be indicating the beginning of a new.
Yeah, and I wonder if we just had, we've had small caps, quote unquote, play catch up for a little bit. And mega cap tech just continue to move higher. I would prefer, I don't get to pick.
What?
Anyone out there is listening.
You don't get to pick your market?
I did get to vote. It would be for a little bit. That doesn't mean we can't have, I guess, breadth can still be fine. I'd personally like for some other things to outperform for a while, but alas, I've never been asked for approval on what trends do. So,
wait, are you telling me that the market doesn't care what you think?
Personally, no. I've heard rumors that some people do get to vote, but I haven't been invited. I don't know how to get in those circles.
Okay.
If anyone in those circles is listening to our podcast, let me make my pitch for continued breadth from other parts of the market. And we do see that, right? Industrials. In fact, I believe it was Austin Harrison who, and we've talked about this a little bit, but it was kind of finalized this week. Industrial is actually the first sector to new all-time highs.
Yeah.
So it is not all a tech mega cap conspiracy, but I would just like some more of the same environment we had in June.
You've got industrials leading, and you've got tech not far behind, and you've got semiconductors leading.
Home builders still continue to
home builders.
Yeah, I don't know, right? And that goes against a lot of the headlines.
Well, and you look at something like home construction, like ITB, and we're just going to slice through all-time highs like butter, like a hot knife through butter.
Well, and then it goes back to foreshadowing because you had a lot of these individual home builders do that. You had Pulte that did not. Now, Pulte really didn't even have a retest.
Yeah, it was shallow. It didn't even get there.
I mean, that sucker's just, I don't know when it's last.
Just sit back and listen to what we're saying. You have it. You've got industrials going at new highs. You got semiconductors going at new highs. You got
weekly all-time closing highs this week. Well, as of right now, if I look at SMH, all-time weekly closing highs.
And you're going to have FANGs go out at new highs. You're going to have home construction go out at new highs. Please tell me, and I'm sorry that I'm being a little facetious, which one of those is bearish? And if you're caught with swimming with your swim trunks off and you're not participating in this, it gets really hard.
Another one I'll add is one we've whined about a lot is can't do anything with emerging markets until China does something. Well, it kind of got its act together this week, and that is helped by weakness in the dollar. It's probably a big development we should cover.
That's probably the biggest development this week.
So big break in the dollar index this week. Big red candle. We broke below that 101 level, which Dave and I have talked about quite a bit in the past. So now we're down below 100. If we stay below 100, that would be a pretty big deal.
Oh, for sure. What Ian is painting is DXY, the trade-weighted dollar, 101, 100 is an important level that's gone back. It was a high in March 2020. Recognize that time frame, right? That's before the COVID correction. I should correct myself. The beginning of the bottom out of the COVID correction, it was the high in 2016. And so here you're sitting in an environment. We've come off of an important bottom. You have the trade weighted dollar breaking below 101, 100. And those are environments. And I think this is where people's minds might implode or explode is, could you just be getting started in an environment that looks a lot like 2017 and a lot like coming out in 2020? It's very possible, considering the evidence we just presented with the VIX, now the evidence with the trade weighted dollar. And I'm not here to say it's just like every day and week is up. There's also a seasonal portion to this where mid-July through mid-September tends to be relatively weak in a pre-election year. That we could just move sideways. We could correct 6% back into 4,200 in the S&P and then move higher in the final piece, the strongest 6 months heading into the end of the year. That's very possible.
One thing I'll also add is, so from I guess you call it the price thrust, so we're now 10% above the 200-day moving average.
Okay.
So I did a little study and I posted this on Twitter. I looked at periods where the S&P had been at least 6 months below the 200-day moving average, and then the initial subsequent move to 10% above. So,
I like this.
At least
I like this.
Under. So a multi-month downtrend. Plus, we know takes the S&P a little while to turn. So really, probably there's probably like 7, 8, 9 month downtrends at a minimum, and then the initial move, the initial thrust, quote unquote, rally off of those lows. So we've reached that now.
Okay.
At May 2009, summer 2004. We've got 1992. So it's easier. I can have David Yoakum retweet this, or you can go to my feed. I'm a visual person anyways. I've marked all these periods going back to the whole history of the S&P. So I will let you make your own decision, those who want to go check it out, whether you think the last few months have been long-term bullish or bearish.
No, I like this. You're saying that you took reclamation of the 200 after being below it for a while.
Yep.
As a type of thrust.
Yeah, I mean, right? Because it's like still a lot of stuff that comes up is, too far, too fast. Look at what we've done off the October lows. I certainly wouldn't say straight up, especially because we just talked about a consolidation from February through the end of May at 4180.
Wow, I'm looking at this now. There's only one instance in the data set, and it looks like it's like 1979-ish.
So there's only one instance where like you're above the next signal.
Right.
Like, so you basically had to go through another pretty big drawdown.
The rest of the times that this happens, it is a type of thrust. You move higher from here.
And yeah, sometimes I think there's once, sometimes you do catch, I'm not saying we can move sideways for a few weeks or months. I'm just saying when we look out for the second half of the year, 2024, I would say the next 2 years, 3 years, right? And a lot of this includes the 70s, though, where you got a lot more signals than clearly you've had the last 30 years.
Sure.
Just because we had a sideways market for 12, 13 years.
Right.
But even those were great signals.
Yeah, for sure. Like you went from an extreme position under the 200-day moving or 40-week moving average, and you reclaimed and went to another extreme. You're 10% above it, and now you've got, I get it. It's a good measurement. I see what you're doing there.
And so it doesn't mean we're finishing the year up 45%. And it doesn't mean that 2024 is incredible. But again, if you want to look out, 24, 25, 26, it's hard to deny. And this has been thrown out a lot. If this would be one of the strongest bear market rallies ever.
Right now.
Yeah, based on most.
Oh, I see what you're saying. Like we return to a bear.
Yeah, it would be a total middle finger to the data.
It'd be the one instance.
Yeah. Now, Ryan Gorman, I was talking with him. This was a couple weeks ago, and he had shared with me that I think it was Ned. I want to get Lowry's. So Lowry's had put out a report, and this is just to be open-minded that if the bear market's over, this would be the worst participation from the Russell 2000. So
okay,
there's also that.
I think it's a fair, when you're looking at data sets, to say this would be the exception to the rule.
Mm-hmm.
And here's the deal. If you're going to have a thesis, which is how we should operate, and price should confirm or refute that thesis, if we were to, and this is how it applies to our clients and their accounts, there's about 6% volatility that sits between here and 4180 again. If we were to close back below 4180, that would be information and something that would need to be acted upon, as well as closing below a 200-day moving average.
Yeah.
And so these things are allowed to happen. We're not sitting here in the mid-July and saying that the market can't correct from here. That's not what we're saying. It absolutely could roll over. We close below 4180. We close below a 200-day moving average, and we're back in cash.
Yeah, that would suck, and that would be represented in portfolios pretty quickly.
Yeah, exactly. And I think it's okay to understand that that scenario is the least likely scenario. We don't get to sit there and be like in disbelief if that were to happen. You just act upon it. And so we're ready to act in client portfolios on their behalf below those levels. But what Ian is saying is the likelihood of that happening is not very high, even despite all the narratives that are out there. And what does it look like in 2024? I have no idea, but you could see price higher from here, and you could also see a sentiment where it's higher forever. And that's where you want to get really nervous. Time will tell.
Yeah, I agree. And I do wonder, right? Because we've now gotten to the point where, and we'll see if this mindset takes place. Again, not like I have the insight to every financial advisor or asset manager in America and how they're positioned. But this is how you kind of get into these by the dip. Everyone feels that they've got every 1%, correction that they get is an opportunity to add stocks. And then that's how you get in these cycles of melting up.
And that's probably
right? How bad was 2017 supposed to be? So bad because Orange
because of
president.
Trump got elected in November.
Oh my God! After he won in November, the entire 2 months leading up to, oh my God, how should you be positioned in 2017 with Donald Trump as president.
The market was going to crash.
And then you get halfway through the year and it hasn't crashed. And everyone who decided to stay in cash or go to, I think Krugman was saying his big thing was, I'm moving everything to emerging markets. So all these things that were supposed to happen. And then people get to halfway through the year and they're getting questions, right? Well, why don't you own stocks if the market seems to go up every day, right? That was the year where the market and it was just like a little bit every day. Just 25 basis points a day, 35 basis points a day, zero
lowest fall on record
corrections, which I think one of the only, I don't know if it's the only year in history, but to have zero, by most measurements, I think it was the lowest volatility record on history.
100%. It was the lowest volatility year on record. And I believe
is he going to nuke a bunch of, as soon as he got out of office, he was going to nuke a bunch of people.
Yeah. And isn't the irony that he's the only president we've had in the past quite some time that didn't initiate war or want war? And yes, 2017 was historic in that I don't think it had greater than a 3% pullback. It was
crazy.
And could that happen again? Absolutely. Considering that, is this move, okay, I think there's two theses out there. And obviously there's always more. But one of them would be that this is all short covering based. And you go make a new high in something like the S&P 500, and then you close below that new high. So the S&P 500 all-time highs around 4,800.
Okay.
So you move, you melt up, you have this short covering, the squeeze that happens, you move above 4,800, and then you close back below it. And that's the beginning of a panic type scenario in 2024 that matches the gone panic cycle. But you also could have an environment where you move up like 2017 and volatility is low. There's barely any pullback, like that BTFD statement before. Like there's no FD to buy.
Yeah.
It just keeps going.
Okay. So let's say you were short, you capitulate. Now some of these visually into a lot of people when they pull up their non-log scale charts and they see NVIDIA or whatever, and like, oh my God, well now it's an even better opportunity to short. It's rallied 200%. So, I mean, I still think that there's satellite, for lack of a better word, satellite stocks out there that kind of keep people with, oh, I'm not wrong, I was just early. Because look how crazy this stock has gone, and NVIDIA clearly can't go like this forever. Which I agree, it can't go like this forever.
It's too high, Ian.
On it for like another 2 years.
It's too high.
And again, you talk about, what are you doing with Apple at all-time highs doing and consolidating up here? Also hasn't got, I'm not saying a retest can't happen. If we get to above 200 in Apple, a share, and you got no retest of 180, 183, not bearish.
Let's look at some of the math on this. So Apple, okay, most important stock on the planet.
Yeah.
From December of 21 through May of 23. So way over a year has a 0% return. That's not going to then provide a return.
Microsoft basically flat.
So you have some pretty large cap, mega cap, really important players who have underperformed, right? Because the average, again, an average annual return of the market is somewhere between 7 and 9%. And you have something like Apple and Microsoft, who are supposed to be the leaders, who moved for a year and a half, 0%. Is it really that ridiculous that now that they've cleared new highs, that they're not just going to continue to basically make up for that difference? And then what's the flip side? The downside is always viable. So what would that look like? So to you, Ian, if we were to roll over here and correct, 20, 30%, we would have price to work with. What are some things that we'd be looking at to identify that that's taking place? I think, one place off the top of my head is If the NASDAQ's below 360, using the Qs, QQQ, that would be one piece of information that would say,
be
okay,
a little suspect. I think IWM back below its 200. So if it was to, well, one, let's say it goes back below 1900 and then back below 1800, that's your 200-day moving average, or it was. I'm sure we're a little bit above that now. No, pretty much 1800. Yeah. That would be a little alarming. You really don't want to give up much in the rock. It's got so much work to do. It's got a hole to dig in or to dig out of. And I really don't want to see any dirt fall back in because that's just going to make it harder.
Yep. In the meantime, you've got areas like international that's participating, not outperforming, but participating.
Yeah.
And there's some areas that are outperforming. So that's risk on behavior. And I could make the argument that participation has just begun. And what I mean by that is if you have a relationship like the Russell 2000 versus S&P 500 at a level that we haven't seen since the COVID lows with an RSI divergence, that if we see this area hold, that would mean participation is here. And that's happening during the summer.
Yeah.
If that's happening during the summer, that's pretty bullish. But here we have price to manage risk with that, if the S&P is back below, let's call it 4275, and the NASDAQ 100 is back below 360, and technology as a whole using XLK is below 174, or semiconductors, a hugely sensitive area, are back below its previous highs, and let's call it 150. Well, then we can start having discussions about what is going on here. Is this massive distribution? There's a thesis out there that all this is a short covering.
Yeah.
And this is about to be one massive distribution. I'm open to that. But right now, if you're staying above the highs, that means buyers have control. That's the lower likely thesis that we're having some type of correction on our hands. And we haven't even touched base on crypto or commodities or
good week.
rate or
Bitcoin continues to stay above 30,000, just consolidating up here.
Yeah, we'll see where that plays out when you look at rates or using something like TLT to measure 20 plus year treasury bonds remain above 100.
Yeah, didn't hold the breakout on rates above 4%.
And that's a range that's been in place since November of 22. Time will tell.
Yeah.
Anything else, Ian, that we want to touch base on before we close down the recording?
No, I just think, we've had a great run. Yes, off of October, but really since we've broken out of this range that we spent majority of the first 2 quarters in. I think long term, what's happened bodes pretty well. I don't know what journey we take over the coming months and years, but would like to err on the side that it's going to be bullish and up and to the right. I don't know what outperforms, but it seems to be, given all the data, all the charts, that the worst is behind us.
Yeah, worst is behind us, and we're also allowed to consolidate here from mid-July, a seasonal week period through mid-September. So we could see a 2-month period of cooling off.
Good.
And then move higher from there. That would be perfectly normal.
Probably
and
painful in some areas.
Yeah, painful in some areas. And that's okay. Like I said, between here and 4,200 approximately is about 5 to 6% in the S&P 500. There's nothing keeping us from moving in that direction and correcting through time. It's not like that's abnormal volatility for something like the S&P 500. But I do want to highlight that this podcast is sponsored by the Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. Adaptive Select helps investors access 2 of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. I also want to encourage our listeners, if you appreciate this information that we provide on a weekly basis, please give us a high ranking on whatever platform that you're on, and then share it with your friends. That's one way that you can repay us for the time we put in, the information we provide. So Ian, great to be on here with you again. Summer is here, mid-July. We hope everybody enjoys it. Take care.
Have a great weekend, everyone.